Good morning, good morning, and good morning once again to our weekly broadcast. It's Thursday, 10 a.m. once again. We haven't been here for about 3 weeks, which is why you got 3 good mornings in a row to make up for those ones that we were off in August. Welcome to Cary Yuen, our special guest today. Good morning, Karen.
Good morning, David. How are you?
Yeah, fantastic, Karen. Good to see you again. Thanks for joining us. And of course, my resident co-host, Mr. John Corey. Good morning, John.
Good morning.
So you had a lie-in for a few weeks, saying we weren't doing the broadcast. You're obviously, for those that don't know, John is based over in America. So you've had to get back out of your bed. What time is it right now in your part of the world?
Well, I set the alarm for 4 so I can get a little bit of motion going before I have to sit here and sit in wardrobe and then have makeup, have my hair done, and then go live.
Very good, very good, very good. I think I would sack your hairstylist this morning, possibly, but
Hey.
Oh, you're joking. No, listen, John, again,
I think
thanks
they were
very
commenting about your hair.
Yeah, no, I got the barber this week, so I'm happy enough. But listen, John, thanks again. I know it's an unearthly hour to be dragged out of bed, but we do appreciate you coming on and looking forward to today, everyone. Thank you for joining us. We've got big numbers in today, obviously because of the topic and because of the guest. I think it's a combination of both. So let's get straight into this. First of all, market update. We haven't been here for, I say, 3 weeks. So, John, we take a few weeks off. We get a new British Prime Minister. We get 2 new, or well, not new yet, 2 football managers sacked. Thomas Tuchel was sacked yesterday from Chelsea. Scott Parker was sacked as the Bournemouth manager. So we take a few weeks off and it's all changed.
Well, yeah, I mean, we look at the Queen. So this is her 15th prime minister. They come and they go. It's a short-term job type of thing, 1 to 5 years or something. I want people to hear this in the context of property investing or real estate, that you invest generally as a landlord for long term. We're talking decades. The economic results are generally best if you buy and hold, while you can do short-term deals. If you do, you're exposed to the market turbulence. If you want to not have that exposure, then you need to think longer than a prime minister. So,
yeah. So this Liz Truss, don't know a whole lot about her, but she has been quite vocal in recent years about the property market, which is interesting, why it's relevant to today. So she has made some pledges, if you will, although politicians and pledges is another interesting topic for perhaps another day. But she has talked about tax cuts, talking about a tax break for cohabiting couples. She's talking about reversing the planned rise corporation tax, and also like getting rid of what she called the top-down standardist housing targets that were set. So we'll be interested to see whether she implements these and these could have an effect on the property market.
They could. There's a number of things she said that it's unclear that the world's going to let her do it, in the sense that some of her economic policies depend on the bond market, and the bond market's not so happy so far. The exchange rate, sterling to dollar, sterling to euro, is at a relatively all-time low. I think it's lowest in 6 decades or something. So there's already been some feedback about maybe some of the things she's saying needs to be dialed back. Yeah.
And again, there's the whole issue around saying what maybe you need to say to get votes, and then when you're actually in the hot seat, what's pragmatic and what's possible. So we will watch this space with interest and see what impact it does have on the property market.
Yeah, and it should be obvious to everybody that's British, but what she was saying to get votes was to get votes only from a select group, the actual Tory party members. It wasn't even to get votes in the public. So
yeah, no, that's a very good point. Very good point. So, well, we'll watch this space and see what happens. So before we move to Karen and our special topic today, we like to do a brief Ask John section. This is to sort of dig into the wealth of John's experience and his knowledge. So the question this week that was asked is there anything in the current property market environment that is giving you cause for concern as a passive property investor?
So, yes. And I think maybe more important than Liz Truss is Scotland declared a moratorium on rent increases. So they've completely frozen rent, both for social housing and for private landlords. It's, quote, temporary, I think it goes till March of 2023. Second is we have the rising interest rate environment, which is in response to inflation, which is in response to a war. So these are very much macro events that are having impacts. Rents are going up. Cost of living is going up, cost of materials going up. So there's lots of turbulence. Now, on the plus side, you could say, well, we have the same number of people. People are still essentially being born. People are still living longer because the NHS works. So therefore, there'll be continued demand for housing. There are anecdotal reports from landlords that tenants are very happy to stay put rather than move. While they don't want to pay higher rents if they can avoid it, they'd rather pay high rent than have to go into the market and compete with everybody else for a limited supply. So there is a lot of turbulence out there, but if you take the 20, 30-year view, then, just essentially have more cash, less debt, and continue to stay the course.
Okay, thanks for that. It's something that since I've known you, you've always talked about the long-term view. And it's something that you do constantly return to when it comes to discussions about property, that you got to see this as a long-term play, and it's a long-term game effectively.
Yeah, I mean, you can avoid actually a lot of the negatives because a lot of it smooths out over the long term. And frankly, inflation is good for real estate investors. There's a couple of reasons, but in the short term, it's painful and your costs go up and all the rest. But frankly, real estate is generally seen as a good hedge to inflation. So if we have higher inflation, you're likely to see your assets are going up and your debt is melting away.
Good point. Good point. Okay, listen, thank you for that. Okay, in terms of the platform, we have 2 new projects that are being prepared for launch. There is a planning uplift project, Stafford Gardens, which is being prepared to go view deal. We've actually had one of our planning projects that's received approval. We'll be announcing that probably next week. So absolutely delighted with that. And also there's a coming soon for a Dunlickety House, which I think is how the native Scots pronounce it. Dunlickety House up in Inverness, a really interesting project. John, I know you're involved with this one, and it's a beautiful location and certainly an interesting structured potential investment for people that we'll be able to talk about in the next couple of weeks.
Well, the first one I don't know about, but I think it is what it says. It's a planning application for development, where the second one is at its essence, it's a serviced accommodation or short-term holiday let property, which is going to have income almost from day one, existing structure that can be easily rented. And then there are opportunities down the road for further enhanced value when it comes to either planning and then constructing some new units, or selling off some of the land, or splitting off elements of the project and doing other things with those elements. So, I mean, I see this fundamentally as a cash flow project that has benefits or bonuses or cherries on the top or extras. And people do need to read the documents and decide, what's best for them. Fundamentally, though, that you have 2 different projects here, quite a bit of difference. One is going to have more immediate cash flow. One's going to be very focused on just the planning side. The first one, David, do you know who that is? Is that an existing fundraiser that's already been on the platform? So we might know them as a prior raise?
No, this is their first raise. It's Mark
Okay, very good.
Is behind it. And
so that's nice, a little diversity again, because both of these are new to the platform.
Yep, absolutely. And Wendy and Karen from Forget Me Not Properties are the ones behind Dunlickety House. So yeah, so keep an eye out for those, and you'll be able to read them when they're view deal. So let's get straight to our special hot topic today. We always keen to have comments and questions, so put them into the Q&A. If you have any questions for Karen or John, put them in the Q&A. We don't use the chat box, and always keen to have comments. And if you have questions, of course, get them as well. Yes, John?
There is one in the Q&A right now that's got nothing to do with FCA. So if we want to address it, we should probably do it well. That other slide.
Yeah, that's down at the end, Bubba. Just
okay.
down at the end. So Karen, over to you. Thank you for joining us. So do you want to give a quick overview on your background and your credibility in this area of compliance and legals, which is, I describe you as an expert, and that definitely describes you. So over to you.
Thank you very much, David. So as David has kindly mentioned, my background is indeed in legal and compliance. So I qualified as both a barrister and solicitor in the UK, and then I subsequently spent 10 years working as an FCA compliance specialist for various financial institutions in both the West End and in the city. And then in 2014, I discovered property, and I started off as a hands-on investor and eventually moved into being a hands-off investor. So a private investor that invests in other people's property deals. And more recently, over the last 2 years, my husband and I have been helping property developers and investors with their fundraising process and their investor packs. And last year, we founded The Investables, where we help property investors and developers to come across as investable and make it easier for them to raise investor finance. And following compliance rules is a key component of being investable.
Yeah, excellent. Thank you. Really good introduction. So I've been on I'm actually a member of the Investables, and I have been speaking at some of your events, and yeah, they're very enjoyable because you get a lot of professionals in your network, and the discussions around these topics and just property development in general are very informative. You get a lot of different expertise in your network.
Yeah, I think it's definitely great to have a bunch of like-minded individuals who are all keen on doing things right. And as a result, we get better discussions. So it's been a really good place to be.
Brilliant. Okay, so I know you and John have been probably trading emails and long discussions into the night. There are people who like to read all the words and all the documents, and Karen and John fall into that category. I think I'm like most people. The thought of reading 136 pages of FCA policy statement would not be top of my list, to be fair, of how to spend my time. But this is essential stuff. So I think as a starter, perhaps, Karen, you can comment too. The FCA have clearly said that the approach that they've been using in recent years has not been working as well as they think it should. And is that really the driver behind, if you like, the clarification and perhaps the tightening of the regulations?
Yeah, I think the FCA has definitely been seeing a lot more consumers investing in high-risk investments that are not compatible with their risk appetite or risk profiles. So people investing in investments that are not right for them. And the FCA is all about protecting consumers. And as a result, they are introducing clarity via their policy statements to help protect these consumers.
Okay. And John, you obviously, I know you've actually, I think, took part in the consultation paper that led to this policy statement. So where's your kind of take on where the FCA are at, and what's the driver behind this latest policy statement?
Yeah, just to frame this. So this document came out on August 1st. The things they're proposing are declaring, not proposing. They'll come into law, into effect later this year, early next year. It's very clear dates in the document if people want to see it. But there was a consultation at the start of the year, and that's what I participated in. What a high point of this is, they're saying we're not really changing the rules as much as we're clarifying the terminology. I would argue there's some subtle changes in the rules, but fundamentally this is to make it easier for people to understand which swim lane they're in, and how the rules apply to various activities, whether you're raising money for a property deal or whether you're doing something in a company space or crypto space or things like that. So this is all about clarification, transparency, making it easier, as Karen said, for people to know what they need to do.
Brilliant. So Karen, for someone who hasn't read the document and they want to know, okay, what are the key takeaways? What do I need to be aware of? I'm a property developer. I want to raise funds from private investors. That's what I've always done. I didn't know that I wasn't allowed to do it. What's the key takeaways from this policy statement, please?
Yeah, so there are quite a few key takeaways in this policy statement, and I will summarize them for you very shortly. But as you know, I need to highlight that the devil is always in the details. So just taking a short snippet is never going to be enough. But for the purposes of this broadcast, because we don't have all day, the key changes that you need to be aware of are that there will be a new investment categorization. There are risk warnings, new risk warnings that are going to be introduced, well, that have been introduced, and these include personalized risk warnings as well. There's also an introduction of a 24-hour cooling off period, which applies to new investors. You know, this is brand new, it's not done before, and they are introducing this. There are also new investor categorization forms. So they've sought to provide clarity to the high net worth investor and the sophisticated investor statements that some of you may have seen. And I think, you know, the feedback generally that I've received from the property world is that it's quite difficult to understand. It's very text heavy. And what the FCA has done now is to provide clarity in these forms. And then the final point, I think the final change that they're introducing is a stricter, but yet clearer rules on testing investor appropriateness. So making sure that the investor is right for the investment that you are looking to get them to invest in.
Okay. John, any comments to those points?
I think that was a really good summary, and it is about ultimately trying to make sure that the investor knowingly is making a decision, that they understand the risks they're taking, that they've been through a process. So hopefully people who shouldn't make decisions, shouldn't make investments, are backing out. As Karen highlighted, I'll label it slightly differently. They're putting a speed bump into the process. When you bring on new investors, you literally have a cooling off period before they can see the full details to make an investment. They want to introduce what they're calling positive friction, where it is slower to make an investment decision, gives people time to rethink what they might have thought they wanted to do.
I mean, that speed bump you talk about, John, is actually, I mean, I think it makes sense. You can understand why they've introduced this. I'll have to change my my language in some of our property webinars or project webinars that we do, because we have had people, and I sometimes refer to this, that who registered for a project webinar, who then during the webinar went on and did their appropriateness test, AML, KYC, and made their investment pledge in the space of 8 to 10 minutes. You know, so what the FCA are saying is now, no, that's not good practice. People need to, if they want to register, great, but there needs to be then a delay where they like return to the decision that they're thinking of making, almost with after a night's sleep, or with a fresh eyes, before they make the decision on that. Now, interestingly,
Yeah.
Karen, so go ahead, you want to comment on that?
I was just going to add that I think the FCA has even gone on to say that after the 24-hour period, that the potential first-time investor will have to reconfirm their desire to invest. So, you know, a positive reinforcement. So it's not enough that they've stated it 24 hours before, you've cooled them off for 24 hours, they need to reconfirm. So that's the extent the FCA wants to make sure that the investor really knows what they're getting into.
Okay, interesting. I actually hadn't picked that bit up. So thank you for clarifying that. That's a very important point. And in some ways,
David, is you and others in your space, crowdfunding space, you have platforms that'll implement this, and then it'll be consistent. And this particular thing is only for new investors to the platform or to the person raising the money. But because you're automated, because you have process, you can build these things in, it can run smoothly. If someone's raising money on their own and they're doing it as a manual process, it's going to be a bit of a nightmare, because they have to be able to document that they did follow this and that there was a 24-hour delay, there was positive reconfirmation, and maintaining those files for 7 years or whatever the FCA requires. It's like, I keep saying to people, there is no money in running a compliance operation. You should outsource compliance and get on and finding your next deal.
Yeah, that's a really good point as well. I was going to say, Karen, you kind of, as we do, deal with property developers, and I find it amusing is the wrong term to use, and frustrating is probably the wrong term too. But it's mind-boggling and eye-watering with equal proportions when you talk to a property developer who just doesn't seem to be aware of the whole regulation and compliance around raising funds from private investors, and you kind of get a cursory shrug of the shoulders. Yeah, I read something about that at some point. It's like, this is your business. You're a professional property developer. How can you not know what the regulations and compliance, if you cut corners on compliance, do you cut corners on health and safety on your sites? Like, what else do you cut corners on? Would you have a similar frustration when you're dealing with developers?
Yeah, I mean, absolutely. I mean, there are many different types of people in the property world. I mean, we've definitely come across the good ones who are really keen on making sure that they are, dotting their I's, crossing their T's, so that they and both them and their investors can sleep soundly at night. And then you have the other ones who are, more willing to cut corners. There's a lot of advice out there, and not necessarily all of them are good advice. And people will, I think John would say, hear what they want to hear. And I think a lot of credit has to be given to John for raising awareness in the property industry for PS13.3. That's a very important piece of legislation or the rule that came out from the FCA. But unfortunately, that is the only policy statement that seems to have stuck in the property industry. And since that policy statement, there have been, several other policy statements. For example, the one that we're talking about today, there was another one in 2020. So that's PS 2015 that covered speculative illiquid securities. But these PSs, policy statements, for short, they're not being talked about at all. Everybody just goes back to PS 13.3. And it's great that they are aware of that. But compliance is an ever-changing landscape, and you, as the fundraiser, the person who's raising money for your projects, need to stay updated on the rule changes. Otherwise, as John says, outsource it to the crowdfunding platform. Don't take on the compliance burden, because it's simply too much.
Yeah, no, that's a really good point. And some of the changes or the updates or the clarifications, if you will, in this policy statement, some of them come into effect actually on the 1st of December. So we're weeks away from some of these being in effect, and the majority of the rest of them by the 1st of February of next year. So, I mean, this is relevant stuff. So, John, as we've discussed this, you talked about this image as part of the policy statement, almost being a good capture of what's happening or snapshot of the market. Do you want to just speak to what this image is referring to?
Okay. So folks, everybody who's listening live, listening when they watch the recording, if you do nothing else, this is the one thing you need to focus on. And it basically breaks down the investment categories. So the green means there's essentially, for the purposes of marketing, no marketing restrictions. Those are the opportunities that are in that bucket are going to be on a stock exchange or a bond exchange. These are the ones that, you call a broker, you say, want to buy, want to sell. They make it happen in a few minutes. It takes a day to settle. So frankly, probably none of you are dealing with this when it comes to property development. The middle category mostly is going to be your crowdfunding platforms, whether peer-to-peer or it's going to be the equity crowdfunding platforms, which are referred to as investment-based crowdfunding. So this is where essentially someone else is providing the compliance, they're running the process. They have permission to make sure that information is collected at a certain speed in a certain way, but also that the information can be shared on all social media for UK residents. You can publish things, you can share things, you can say things to anybody who is of a legal age and a sound mental mind. The last category is mostly for essentially property investors and others who are trying to do their own deals directly, where you're essentially now saying, I want to take on the burden of running a compliance operation. I'm going to classify the type of deal I have, whether it's an SIS or not. I'm going to essentially make sure the retail investors do not even see this stuff. Now, as I said earlier, this policy statement is to clarify these swim lanes. It is to clarify some of the language. As Karen highlighted, it's to tweak some of the words for the disclosures and other things and put it in speed bumps. This is not necessarily releasing that much information about new rules. Many of the rules that are applying, they've already been in existence December 2020, more or less. So for anybody who's doing a real estate project in the UK that's adding value, that's probably going to be a SIS. There's a couple exemptions. Karen can highlight them if she likes. But essentially, if you add value to a project, the future is uncertain, and therefore it's speculative, and therefore there's more restrictions. to get through those two exemptions, yes, you can do it, but it means probably dealing with high value or high level investments. So if you want to get into the yellow or the green, you're going to have to change what you do. You probably cannot do it directly. You're probably going to have to outsource compliance and use a more traditional sort of exchange model. If you're going to try to go direct and you're going to try to have conversations with your investors, you're probably mostly in the third category, the red or the whatever color that looks to you. Then Karen, if you want to highlight the 2 points about how you might slide back into yellow.
Yeah, so the exemption is if you invest in an income generating property. So an income generating property is one that is already cash flowing when you purchase it, and you will continue to rent it out, and you cannot have any planned development works for it. I think a common question I tend to get asked is, okay, that's fine, I'll buy an income generating property, but can I then do development works to it at a later stage? So, categorically, no, the FCA says that it has to be an income generating property, for the duration of the investment. If you have any planned works at all, that takes it into a different category, which is what John was just highlighting. I think the important takeaway for most people dealing with property investment is that property investment is high risk investment. We see a lot on social media about people using the words such as, it's a safe investment, it's a secure investment, why not leave your money in bricks and mortar? The FCA does not see it the same way they see it. It is not a safe investment because things can happen. It's volatile. So if it's a high risk investment, there are restrictions that apply and there are rules that you need to follow. So that's key, like rule number one. People need to understand that property investment is high risk investment. So if we can get that across, then we can start telling them about all these rules and restrictions they need to follow. Otherwise, I think they just go, no, the opportunity I'm offering is safe, so I don't need to follow any of these.
Brilliant. That's a really good overview. So thank you both for that. So again, there is time if anyone wants to ask a further question or make any comment on anything that's been said or any observations you have. I can see from the large list of attendees, there's plenty of property professionals on the broadcast today. Many of you have got your own experiences and your own knowledge around compliance and regulation. So happy to have comments that you would like to make on this or anything John or Karen said. So yes, John.
So there is a question before I address directly the question. So many people are aware of policy statement 13.3. The important point there is the 13. It's from 2013. It is old. I would argue it's out of date, and that if you follow it, you're going to get yourself into trouble. Particularly if you follow it and think that doing a fixed return offer is fair. Well, it used to be, but as Karen just highlighted, it's essentially a speculative investment security in most cases. So following 13.3 will get you into trouble. And just sort of abandon it for the most part and just get more current. Second, the question that originally came in is how do you outsource compliance? And I would argue that to get into the middle column, that is essentially where you're outsourcing compliance. You're using someone else who's already authorized by the FCA to approve your offer, to manage the process, to monitor the process. This particular policy statement does spend a bit of time talking about what those people who provide that service need to do. For those of us in the real estate space, property space, fundamentally what that means is your cheapest, fastest way to get those approvals is going to be using a crowdfunding site, peer-to-peer if you're going to raise debt, and equity crowdfunding, so IBCF if you're going to use raise the equity, the stuff above the loan. I generally argue that peer-to-peer is a waste of time, only because there are lots of great lenders out there, so there's no particular advantage in that direction. But if you go to any of those lenders, including the peer-to-peer platforms, they generally say, okay, fine, where's the rest of the money coming from? Where's the equity? And that's where you need to find a way to raise that equity. And that's what you end up doing by using an equity-based crowdfunding platform.
Mm-hmm. Okay, good. Okay, last slide then before we move to wrap up. And John, you can deal with other questions that have come in after this slide and direct them to yourself or Karen as appropriate. So this, Karen, is just really a diagram that's showing or demonstrating the speed bump that John mentioned earlier. Do you want to just sort of speak to this sort of process that they've laid out? It's always good to have diagrams sometimes rather than reams and reams of text. So do you want to just sort of summarize this, the message they're trying to get across?
Yeah, so in this particular one, which I think applies to the second product category that was on the previous slide, what the FCA is basically saying is that you can share certain information. So, the basic facts of the opportunity with potential investors. And at the point that they approach you and say that they are interested in getting more information, you have to do a number of things before you can send them what they call a direct offer financial promotion. And a direct offer financial promotion is basically a mechanism where they could actually invest money if they wanted to. So that you would have the 24-hour cooling off period that we talked about earlier, that would apply to first-time investors. So in that 24-hour, you can start onboarding the investors. So you could do things like, conducting checks. You would get the details of the investor. You would show the investor the personalized risk warning as well. And then after 24 hours, you would need to obtain the active consent of the investor before you can proceed. And then you can move into the direct offer financial promotion. So that's when you can show them the document that they were asking to see.
Brilliant. Okay, thank you for that. Nice and clear, step by step. So John, any relevant questions before we wrap up?
Yeah, there's a couple of questions. One is how to get a copy of the slides. And I would actually suggest that you don't get a copy of the slides. The diagrams are actually in the FCA document. So if you Google FCA space PS space 22-10, that's policy statement 2210 is what that stands for. It's from August. The diagrams you're seeing on the screen are literally from the FCA document. So it'd be best if you go back to source. There's a second question, which is about the point we're making with the 3 swim lanes. So David, if you could go back to that. There you go. So the NMMI, which is the acronym non-mass marketed investments. This is about how to release information only to people who can see it. What's not clear, maybe just from this single slide, is you have to follow a strict process. You're supposed to have 0 accidental information leaks. So retail investors cannot see the information. They cannot know what you're doing. If they do, that is a violation on its own, even though you never took money from them. So if you're trying to target just high net worth and sophisticated, you actually have to be very circumspect. You can't use social media and other things to talk about anything about the deal. You can just talk about what you do generally. After someone is interested, but it's sort of chicken and egg. How can they be interested if you didn't say anything? But after they have declared their interest, then you have to vet them to see if they're exempt without talking about the deal. Then you have to see if they're appropriate for the deal. So an individual person who is exempt, high net worth, is sophisticated, you have to then test if there's a good fit between them and the actual deal, given their circumstances, getting married, getting divorced, having children, children moving out, children moving in, having cancer, not having kids, or whatever's going on in their life. You have to start to understand to see if it's appropriate at this time. Do they understand what you're talking about? Do they get the risks? And you make a judgment. So preliminary suitability. After all of that, then you can worry about some of the other steps. So to live in this third column is going to be painful unless you enjoy compliance and reading these things, which is why I'm strongly encouraging people to outsource by using structures that would fit into the middle column.
Yeah. So I just want to
add, those are the questions.
To that, the last column, because John, you asked me earlier about 2 exemptions, and I just realized that I only covered one, which was about the income generating property. So for those of you who are listening in and are wondering what the second one is, the second one is the amount. So anything that is below 100K, it will be caught by the speculative illiquid securities definition, but anything at 100K or above will not be caught by that, and as a result will fall into the second product category, the restricted mass market investments. So to recap, those are the 2 exemptions that would allow you to fall out of the NMMI product category.
So yes, and that 100K is the individual investor puts in 100K. It's not the size of the project, it's the size of what I call the ticket, that if they're lending or if they're buying equity, whatever, it has to be 100,000 or more from that one investor.
Correct.
Brilliant. Okay. Listen, absolutely fantastic. I think that has been really, really useful today to talk about some of the key
One more
takeaways. Yep,
question.
go ahead.
There is no exemption just because you're offering a fixed return. So under PS 13.3, there was, or at least I would argue there was. That is old news. That is out of date. That is no longer valid. If that's what you think you're doing, then you are basically consciously breaking the law without knowing you're breaking the law, because that is not a valid exemption at this point.
Okay, good point of clarification. So no doubt Karen and John could have had a 6 or 7 hour webinar today and filled it with discussions around these points and the nuances and the detail. As you said, Karen, the devil is in the detail. But I think today has been really beneficial. And for those that watch the recording on YouTube, I think it'll be a really good reference point where someone can grab a cup of coffee, block out 30 minutes and then be kind of at least up to date on what's happening around this very, very important topic of compliance and regulation when it comes to property investing. So thank you both for that. I'll give you a final one sentence at the end here. So next week, we are covering the topic of, will renewable energy transform the UK property market? So renewable energy has been around for a while, this discussion, probably on the periphery initially, but with fuel prices and energy prices going through the roof, this is now a very, very relevant topic. Now, I haven't actually had confirmation of a guest speaker, so I'm actually putting an appeal out today. If you're on the attendees to the broadcast now, or if you're an expert that can speak to this, or someone, then please get in touch with me and we can have them on. Feeling that it'll be John and myself, we will discuss this and go through some of the key details. But I think it's a relevant topic, John, just given what's happening with the energy prices.
Yeah, I mean, it is highly relevant. There are some other people, though, that have more expertise than us. So I'm very happy if someone comes forward. I do know a developer that might be a candidate. And just on that, so we're talking renewable. We're talking about building in a style that reduces the need for energy. We're talking about better energy management, even if you're not using renewable. So there's lots of tangents to this that have how to improve housing is sort of an underlying theme. Yeah,
so it's going to be very, very interesting. So that's us for today. So Karen, I'll give you one last sentence from your visit to us today.
Thank you very much. So on that note, I would like to make it clear that compliance is your responsibility. So those of you that are looking to raise finance, it is your responsibility to know what the rules are. And just because someone else is doing it does not make it okay. So you need to make sure that you need to learn what you need to know so that you don't push serious investors away. Sorry, I stole a few more than one sentence, but just had to get it out.
I think that is a perfect end to a broadcast about compliance. So Karen, thank you very much. Thanks, John, once again. And we'll see everybody next week, 10 a.m. for our 30-minute.
One second, David.
Yes, okay.
So one thing you didn't do that people in the Q&A are asking about is, how do they find this on YouTube? Because they want to go back.
We will do some social media posts on it, but if you just go to Leo Crowdfunding, we have our own URL, which is not on a slide, but yeah, reach out to me on the address there, david@leocrowdfunding.com, and yes, I can reply to you there. But if you just put in Leo Crowdfunding into YouTube, you should go straight to our channel. It'll be up, I would say, within 20 minutes. It'll be on our YouTube channel, and there's a wealth of other information there as well.
Second thing about that, post questions under this recording on YouTube. If you have further questions, there's possibly a couple we didn't get to. If you could just repost it onto the YouTube channel, and the Leo folks will make sure that either they can address it or Karen and I will find a way to address it. But yeah, use that as a resource.
Yeah. Listen, thanks everyone for joining us. Hope you find that beneficial, and see you again next Thursday. All the best. Bye, everyone.